pretty well. Manish Sonthalia is our market master of the day. He's joining us right now. He's head PMS, equities PMS at Motilal Oswal Asset Management Company. Manish, it's always a pleasure. Good to have you with us here. Thanks very much. Look ahead for us, Manish. I mean, we're already down 400 today at about 15,800. Put into context where we are valuation-wise, and of course, prospects for the market in the slightly medium term.
So I think we are in a risk-off mode, and everything is getting punished to the hilt, and it's all coming extraneously from outside India, thanks to crude oil prices. The bigger question is that where is that deep value will start to emerge in the markets, given the situation that we are in and the likelihood scenario that's likely to play out in the midterm. So I think markets can fall to 15,000, but below which it would start to look at some deep valuation, comfort that would start to come in the market. So, we are in choppy waters, but in every crisis there's an opportunity, and, one should be positioning oneself in terms of recovery trade. Whenever this whole thing starts to get better, we will start to feel that valuations have really played out on the downside to the extent it would have.
Okay, by the way, big stocks are taking a big knock. Godrej Consumer is down 6%. Maruti is down quite a bit. Ashok Leyland is down 5.5%. Look at Interglobe Aviation, 5.5% down. Bajaj Finance, 5% down. So big stocks, taking big knock. Manish, good morning. The space that's turned on its head is autos. And of course, a lot of factors going against it. But your thoughts on whether it's giving again an entry opportunity, or do you think the fundamental headwinds are just way too much right now?
So food, metals and oil, these are the three major problems in the world economy today. And two of these three, basically metals and high energy prices, goes against the automobile space. And that's what is getting manifested in lower prices from where we are. But my sense is that broadly all of the negatives are there in the price. I mean, if you look at sustainability of oil prices beyond $140 per barrel, 140 to 150 as global majors have been saying, then there's going to be leading to a lot of demand destruction. And it's not going to get limited only to the automobile space. So, it's a case of weighing one's opinion whether demand is going to get destroyed totally. Global GDP growth at 4.5% is likely to come down lower because of very high oil prices. These are the factors to ponder about. There's blood on the street, there's blood in the automobile space, but my sense is that broadly it should be positioned as a recovery play. Assuming that this thing doesn't last for too long, you could see a knee-jerk reaction once things move towards the resolution phase, the oil prices coming up very sharply. So I'd be a contra buyer in the automobile space at lower prices. I really think that this is one sector which has seen a lot of negatives over the last many years, and till about the point in time demand starts to get destroyed totally, we would look at it as a recovery.
But when you say recovery, what do you mean? Will you be buying any of these names now if they fall about 5 to 10% more from here? And if yes, what pockets would you look at? Because for some of these companies, say for Eicher Motors, for example, not only is demand weak, not only is there semiconductor shortage which hits premium bikes, now the third-party insurance costs have also gone up by about 35%. So would you buy those names in a distress, or would you look at other pockets like commercial vehicles?
So commercial vehicle is in a sweet spot. Freight rates have gone up even in the interim, even without the full hike. I'm assuming that there's going to be a full hike today, somewhere down the line in the evening or so. A steep hike, so to speak. So not too much worried about the CV space. As far as the two-wheeler space is concerned, and by the way, we are buying into autos even at current levels. So that's how our position stands. In the two-wheeler space, specifically mentioning of Eicher Motors, look, the 350cc and above really are not getting damaged so badly as the two-wheeler commuter space. Those are getting hit inventory days of around 40-50 days. But the waiting period for 350cc in Royal Enfield still stands a good 2 months. So that's where we are in terms of demand in the higher CC segments of motorcycles. So yes, two-wheeler segment has got impacted severely because of raw material cost headwinds and cost of ownership going up due to higher oil prices. But the higher CC segments are really not. So we are biased into Eicher Motors. We are buying into auto OE plays which are pitching more towards the CV space. Semiconductor shortages were getting better at the margin, but now with this crisis in Ukraine, again things are starting to get little worrisome as per the semiconductor. So things are evolving, but broadly all the negatives are there in the price. And again, third-party insurance rates have gone up, but you'll have to really weigh in as to if the cost of ownership really goes up, that how much gets translated into actual insurance premiums getting paid at higher prices. If there's destruction of demand, then all of this is not going to be that good. But yes, everything negative that could happen to the auto sector is playing out. But as I said, positioning myself for recovery play, assuming that these things are not going to last too long.
Manish, why don't you run us through your 3 best ideas with clear disclosure that this is not asking people to buy or anything, but just, will be helpful to understand the way you're thinking about some of these names.
So I think, I won't take specific names, but I will tell you that technology remains still the best space to be in, given that rupee is depreciating. And, all the fundamental tailwinds in terms of demand, etc., stands intact. And supply side challenges getting better at the margin in terms of, whatever jobs data that we are seeing, etc., coming out. So that's one space. Private sector banking space, again, getting punished way beyond imagination. Things are really not that bad as is being made out to in looking at the prices. And third would be your automobile, consumer discretionary, pick and choose, where there is pricing power, ability to pass on, the higher raw material cost prices to consumers.
Okay, Manish, what about some of these big consumer names like Jubilant Food or a Godrej Consumer? Would you buy any of these stocks now on decline?
No, this space, which has seen a lot of run up, and there's also one more thing, that where there is too much of excessive ownership, whether in the case of private equity guys or FII guys, there's a problem of a supply coming in. And valuations, even though they have corrected, are really not, in the mouth-watering zone, sort of speak. FMCG as it is was struggling with volume growth, and now with the raw material cost pressures, till about Q3, not everything had got passed. So with Q4 and looking into Q1, again things are going bad for the FMCG. FMCG, I think, is a clear avoid given the valuations and the growth prospects going into FY23 and 24. So that's an underweight sector for us. And even in the consumer discretionary space, where there is not too much of a valuation comfort, even at these levels, see, the entire market is moving towards a value style of investing as opposed to a growth. So one needs to really straddle a balance between growth and valuations, and at the same time have sectors where there is too much of valuation comfort.
Okay. Just to summarize it then, Manish, you said that there are some pockets that you're buying into within this distress, like autos, for example. Any other place to hide in this market where the pain may not be as much as the overall market could be?
Pharmaceuticals is one space. Again, healthcare is a huge sector with pharmaceuticals, domestic pharma, overseas pharma, diagnostics, hospitals. I think sticking with domestic pharma, where there's good visibility on demand, and again, not too much has happened in the pharma space over the last 1 year. That's again one risk of sector where one can park one's money. So that's one space. And apart from that, hugely positive on the banking space and the technology space.
Okay, Manish, we will leave it there today. Thanks a lot for joining us. Well, just